Assalamu alaikum. Our topic of discussion today will be pricing decisions and profitability analysis. The decision to set a price within an organization is, of course, an extremely important one. In order to find the right price, companies have to carry out various kinds of analysis, and this decision will be based on many factors, as we will see. In fact, there is a whole economic theory about setting the price related to demand and supply of products. We won't go into too much detail of the economic theory, but just to refer to it and to say how theoretically the basis of price is set in an economic environment. An element that is quite essential when setting price to take into consideration is, of course, the cost of the product. The cost information will very often be an integral and an important part in setting prices. Let's see in the slide. Pricing decisions and profitability analysis. Accounting information is often an important input to pricing decisions. Market leaders or organizations that sell highly customized products have some discretion in setting selling prices. The information that is provided through an accounting system of an organization relating to costs is going to provide the details of the cost. And we are saying that this cost provided through the accounting system is very often an essential part of the price setting process and the decision making process regarding prices. Firms are going to find themselves in different positions within the market. By different positions, I mean some will be large firms, some will be small firms. Usually, when firms are starting out, initially they are likely to be small, and with time they can perhaps grow and gain a greater market share. When the market share is such that the firms can be called market leaders, that would indicate that they have the highest share in the market. The highest share, they are the biggest selling product in the market compared to the competitors. So market leaders will be in a different position as regards the pricing of their product is concerned. They may be able to lead the market. They may be able to set the trends. They may be able to formulate policy which others perhaps will be required to follow. For other firms which are not market leaders, it might mean that they have to accept the market situation as it is. They have to accept the pricing that prevails within the market. So they might have less of an ability to dictate pricing decisions, but nevertheless, for them too, costs is going to be an important element. Pricing decisions will be influenced by the cost of the product. In other organizations, prices are set by market and supply forces. Nevertheless, cost information is required for determining profitability of the different products and the target product mix. That's how it is therefore important for organizations to have good, accurate cost information. Not only that they are perhaps market leaders and therefore need to set a trend in the pricing, but even when they are accepting a market price, they need to make decisions such as product mix, which should be dependent on the profitability of the products they are offering. The profitability, of course, can be calculated and assessed by a comparison of the selling price and the cost. So the product cost is going to be a focus, and a necessary information requirement regarding any pricing that is being followed, or even decisions such as product mix. Product mix, we have said before, indicates what if you are offering to market several different products, which product to produce in what quantity. And therefore, in overall organization terms, we can look at it even in percentages, that of the total production, 60% will be product A, or 30% will be product B, and so on. So in deciding product mix, profitability is going to be the determining factor. We have seen there are other factors like resources available, and in case where there is a constraint on resources, we also said that the constrained resource will need to be maximized, and the utility and profitability of that resource will need to be maximized in order to maximize the profit of the organization. Establishing optimum selling price. We have said that there is a whole economic theory on setting of prices based on demand and supply of products. The economic model shows that firms will set selling prices where profits are maximized. Precise quantification in practice is very difficult. Management produces estimates of sales demand at various selling prices. The basis of setting the selling price, all firms will tend to set the price at the level at which profits are maximized. We will see in a moment that that's not necessarily the highest possible price. Profitability will need to be gauged, and therefore cost will need to be considered to see where the products are going to be profitable. Profit maximization is usually the goal of the firm, and the economic theory tells us that you will have a supply curve and a demand curve. And according to the theory, where the supply and the demand curve meet, that's the point at which price should be set. Now, in practice, this is going to be a hard thing to quantify, because there are so many variable factors that are involved, and the theory is based on a number of assumptions. Of course, under the assumptions, the theory demonstrates some behavior, economic behavior. But in reality and in practice, firms will find themselves operating not under those assumptions, but with many variable factors. So in practice, this theory will be hard to quantify and establish. Nevertheless, we will see that some kind of basis needs to be adopted in order to set the prices. We see from our graph, the graph of the demand curve, that as quantity produced is increased, the price is reduced. In other words, the scarcity of demand also creates higher price. So price setting is going to be an aspect that considers the demand and the behavior of quantities and prices in respect to each other. We have shown a simple demand curve which shows how price at different quantities is going to vary. In order to establish an optimum selling price, a total revenue and total cost will need to be considered. And economic behavior and evidence has shown that usually things like the total revenue and the total cost are not straight line curves. They do not increase in direct proportion to quantities. They are usually a curve. In other words, there is some variation, and it's not a directly proportional relationship. So in these terms, in these situations, the pricing will have to then match the different revenues and their related costs at different quantities. And that will perhaps decide or help in deciding what is going to be the optimum selling price. Estimate of profits at different output levels. Here is an example, and 4 columns have been set out. In the first column, the various prices are shown. In the second column, the probable units sold at those prices. Then we have a column for total revenue, and we have total cost, and therefore the profit. Of course, the profit is total revenue minus total cost. So we can see that at a price of 40, the units sold are 10, which gives total revenue of 400. Here, total cost is 360, giving a profit of 40. Now, as the price goes down and it reduces to 38, the quantity sold increases, and that now becomes 11 from 10. So the total revenue after a price reduction increases to 418 because the number of units sold has increased. At this stage, the costs are said to be 364. Therefore, a profit of 54 arises. Now, as the price goes down further, that's 36, the quantity is expected to increase. It goes from 11 to 12, and the total revenue is now 432. So the total revenue continues to rise as prices are falling because the quantity sold has increased. At 432, the related cost is 370. This gives the profit of 62. And so on, this goes on. And until you find that the price, when it goes down to 28, the units sold are 16, total revenue is 448, total costs 414, giving a profit of 34. As we can see, the profit started to increase initially. From 40, it went to 54, and then 62, 64, and when the price reached 34 and was reduced beyond 34 down to 32, the profit was reduced from 64 to 60, and then down to 50, and finally at the price of 28, the profit is seen as 34. It has reduced from a maximum of 64 down to 34. To determine optimum selling price, it is necessary to estimate the total cost for each price level. Profits are maximized at a selling price of 34. So this is an example of how total revenue is going to behave in respect of increasing or decreasing the price. We have seen that as the price was going down, because the quantity sold was increasing, so the total revenue was increasing. As total revenue increases, we find that the profit was also increasing. Now the costs are also going up, so it's all a matter of the relationship between how, when the price is reduced, the quantity is increased, to what extent the revenues will increase, and to what extent the price will increase. This is going to be the determining factor for the profits. And we saw in our example that gradually, as the price is reduced and the quantity is increased and the revenue increases, initially the profit is likely to increase. But it goes up to a point where beyond a certain level, even when you reduce the price further, which is going to increase the quantities, nevertheless, the revenue increase is not sufficient to match the increase in cost, and therefore the increase in profits begin to decline. So much so that gradually the profits can even fall below the level at which they started. In our example, initially the profit was 40, it then was reduced down to 28. So this is economic behavior, and this is behavior of prices and quantities, and under these conditions, the firm must decide where it is going to peg the price. In this example, at the price of 34, the profit was a maximum of 64. So the firm will try to aim and achieve a price of 34 to give it the maximum profit. We can look at this relationship in a graphical manner, and we can look at the graphs and see how the graphs show behavior of the revenue and the costs, and the graphs demonstrate how profit is maximized at a point within the range, and it is not necessarily the highest price or the highest quantity. This graph shows us that as quantity is increased, total revenue increases in a curve. So it increases up to a certain point, and then the rate of increase starts to slow down. Similarly, with total costs, as the costs increase, they do not increase proportionately, and so the increase rate can vary at different quantities. And this therefore identifies a point at which the profits can be maximized. In our example, this was the price of 34. So there is a point after which, if price is reduced further and if quantities are increased further, the profits are going to reduce and they are not going to increase indefinitely. There are several assumptions which form the basis of the economic theory, hence it is difficult to apply in practice. Economic theory, as we all know, is based on a number of assumptions. The most significant one of those is that all other things being equal. Now, of course, that's a theoretical aspect, and in practice, it is hard to find the exact price at the different quantities, what would be the exact cost at different quantities, and what would be the exact price and at different quantities, and so forth. So when in reality this aspect is hard to establish, then we have to look at other market factors which are in actual fact determining and dictating prices. So given all this aspect, it becomes important to see what the role cost is playing. So cost may not be the determinant of the price in all cases, but it is going to be an important factor. If the cost information is available and we make periodic profitability analysis, we can find which products are profitable, which are not, and therefore important decisions such as discontinuing or continuing and expanding, things like that, are based on this cost information in comparison to the price, giving us the overall profitability. Of course, the overall objective of the firm is to maximize its profitability. The role of cost information in pricing decisions. Small firms operating in an industry where prices are set by dominant market leaders will have little influence over the price of their products. They are described as price takers. The market leaders and highly customized producers are described as price setters. Cost information is vital to price takers as well as price setters. So in a market situation, there are going to be small firms and large firms. The smaller firms are the firms that will find themselves under the influence of the market. They will be faced with conditions in the market which they will need to accept. They will not be in a position either to dictate price or to determine their own price. So these firms we are going to refer to as price takers. These are the small firms, the price takers, the market conditions they have to accept. Usually the market is going to be dictated by the larger firms. They are going to be dictated by the market leaders, the companies that have the biggest share of selling in that market. Those are the price setters. Either the size can determine whether they can set their own price, so they are price setters, or in case their products are unique and they have that aspect which does not have readily available substitutes. So in that case, that price can also be determined by the firm itself, even though the firm may not be a very large firm. So price setters are those which are either the market leaders or those that have a unique product. Price setting firm in short run. Only incremental costs of undertaking a special order to be taken into account. In service companies, for example hotels, the incremental cost of accepting one-off special business are likely to be minimal. They may consist of meals, laundering, and bathroom facilities. Now let's look at the short run. And we are saying that in the short term, basically we have said this before in our relevant cost discussion, that only the relevant costs, the incremental costs, should be considered in the short run. The relevant costs are those which are incremental and those that are affected by the decision. Those are the costs that need to be considered when making pricing decisions in the short term. The short term means that just the situation as it exists, the organization is going on in its own way, and a situation arises that you need to make a decision for a special order. And in those special order situations, only the relevant cost, the costs that are going to change, they need to be considered in setting the price. So we have said that price can be set by firms that have a unique product. So the unique products, the firms set their own price, but in the short run, they may look at only the incremental costs. In the case of services, we have just said that in case of services, these incremental costs may be quite minimal. Basically, when an organization has been set up to offer services, then most of the cost has been incurred, and it has to be ready to offer that service. And the example we looked at was that of a hotel. So for the hotel, the whole building has to be set up, the whole infrastructure, the rooms, the furnishing, all has to be laid out before you can begin to offer the service. In actual fact, once you have started, then the incremental cost of one additional guest is going to be very minimal. When one person comes in and occupies a room, then the only changes that you are making is offering them the meals, giving them the bathroom facilities, things of this nature. All other costs have already been incurred. So in the short run, firms may decide that they are able to set prices for special orders based on incremental costs, and those, as we said, can be minimal in case of service industries. In most cases, incremental costs are likely to be confined to unit level activities. Bids should be made at prices that exceed incremental costs. Cost data is likely to be the dominant factor. Very often we will find that the incremental costs are basically our unit level costs. In our discussion of the ABC system, the activity based system of costing, we have discussed unit level activities. So the unit level activities, we have said, were the ones that are going to change every time the product is being produced, and they are related to units of production. So incremental cost very often will be very close to the unit level activity and the unit level costs. Bids should be made at prices that exceed incremental costs. Cost data is likely to be the dominant factor. So when making bids, the bid prices, therefore, are going to be those that exceed these incremental costs. We are looking at the short run. In the short run, we are saying that what is being affected, most of your cost has been incurred, and unit level activity, those are the kind of costs that are incremental costs. So when you are making bids, the bids can be just sufficient to cover this unit level cost. If the bids are covering unit level cost, then it is worthwhile for the organization to enter into that contract and enter into that agreement. Bidding for prices, again, this is a concept where we are setting the prices for bids. These are special situations. This is not a market open situation, and we have said that when in the short run we are going to set bid prices, those must be within certain conditions. And one of the main conditions is that this price is not going to affect the ordinary normal price of the firm. So bid prices, short run, they are going to be based on the incremental costs. Incremental costs are covered. That's the level at which you can price this product. Special order in the short run. Bids for one-time orders based on covering incremental costs should meet the following conditions. Sufficient capacity is available for all resources required. If some resources are fully utilized, opportunity cost of the scarce resource must be covered by the bid price. So we have said that in the short run, for the special orders, the pricing must be made with certain conditions in mind. And one of the conditions is that there are no scarce resources. The resources that are required to meet the order are all available. If any resource is being fully utilized, then we have said that the opportunity cost of that resource must be added to the bid price. The opportunity cost is the cost which has been foregone. We saw in earlier examples that where one resource was scarce, and if we were going to use that resource in a special order, then the contribution this resource would have earned in its original condition, in its original product, that contribution must be added to the cost in pricing the new product. So the opportunity cost of this resource is the contribution lost as a result of not producing that other product. So therefore, the price is going to be based on resources. Resources must be available, and any scarce resource, the opportunity cost is added on to the cost. Bid price will not affect future selling price. Orders will utilize unused capacity in short period only and released for more profitable opportunity. This is an important aspect, that bid price is not going to affect the normal ongoing price. Because if it were to affect, in other words, you offer a price based on incremental cost for a special order, and that affects the price of the ongoing market, then the loss of profits from the reduction in overall price might be greater than the special order. And in that case, the special order would not be worthwhile. So that's an important aspect, that the price must not affect the ongoing price. And secondly, excess capacity must be utilized. In other words, there is spare capacity for the short term, and this spare capacity must therefore also be available in case of other more profitable contracts, more profitable opportunities. Price setting firm in the long run. In the long run, firms can adjust the supply of virtually all their activity resources. Three approaches are relevant: pricing customized products, pricing non-customized products, target costing for non-customized products. Now, on the other hand, we are going to examine the situation of the long run. In the long run, we have said that the firms are able to manage and adjust the supply of virtually all their resources. So therefore, there is no concept of a scarce resource, because you can add that resource in the longer run. So we have said that there are going to be three approaches that we will take for pricing in the long run. One is the pricing of customized products. Customized products are those that have been made to specific customer requirements. The design can be set either by the customer or by the supplier, but purely for meeting the requirements of a particular customer and not a generalized to be sold to everyone. So these are customized products. So for customized products, we are going to look at pricing in a separate way and compare that to the non-customized products. So the non-customized products will be those products that are being produced in bulk quantity, in large quantities, and are made available to a large number of customers. In that case, the pricing is going to be different to the customized product. And the third aspect we will look at is what we said as target costing. We will examine what we mean by target costing and how it can be applied to products in the long run. Customized products, these are products that should be priced to cover all resources being used. This will require a costing system that accurately measures resources consumed by each product. For price setters, there are stronger grounds for activity-based costing, ABC. We have said the customized products are those products that are made to specific customer requirement. Their design, their manufacturing, their size, everything can be in order to meet the particular requirements of customers. If you are going to meet the requirements of the customer, then all the costs related to the product must be charged in this customer's price. Because this is like a one-off special order and resources are being diverted away from normal production and required to meet the specific needs of any customer. So all the costs that are related must be included in the pricing for these customer orders. In order to arrive at accurate costs and total full costs, you will need a good costing system. And we have seen before that the activity-based costing system provides a good analysis of the resources consumed by the product. So an accurate, well laid out, well set out system of activity-based costing should be implemented for customized products where you need to have a good estimate of the total cost, and therefore the total cost will be included as part of the pricing. If you do not have a proper system to give you the full cost, then the pricing might not be right. And there could be a danger of setting a price which does not cover a full cost, or in fact, it doesn't give the desired level of margins and level of profits. So there's a much stronger case for using the activity-based costing in case of customized products. Product pricing using ABC. The example we'll use is the Cholistan Company. The Cholistan Company has received a request for a price quotation from one of its regular customers for an order of 500 units as follows. The units that are going to be manufactured will need this detail. Direct labor per unit produced, 2 hours. Direct material per unit produced, rupees 22. Machine hour per unit produced, 1 hour. So each of these units are going to require this kind of work and this kind of effort by the company, and they will be required to produce 500 of these units. The number of component and material purchases is 6. Number of production runs prior to assembly, 4. Average setup time per production run, 3 hours. number of deliveries, 1, number of customer visits, 2, engineering, design and support, 50 hours, customer support, 50 hours. So we have seen in this example of 500 units, the order is for 500 units. The detail that we have just covered is the detail required for the material, for the machining, for the production, the delivery, the purchasing. All these are the various costs that have been shown that are required in order to meet this order. We are now going to see how we can arrive at the cost of these 500 units. And using the activity-based costing, we are going to find cost drivers for each of the cost and have a cost driver rate, and then use that rate to arrive at the cost of the product and the cost of the 500 unit order. This slide gives the details of activities required for the order. Activity: direct labor processing and assembly, ₹10 per labor hour. This is the cost driver rate. So we can see that the cost driver for direct labor processing and assembly is labor hours. Similarly, the cost driver for machining process is machine hour, and the rate is ₹30 per hour. Purchasing and receiving materials, the cost driver is purchase orders, and the rate is ₹100 per order. For scheduling production, cost driver is production runs, and the rate is $250 per run. Setting up machines, cost driver is hours, setup hours, the rate is $120. Packaging and delivering orders, the cost driver is delivery, and the rate is $400. Invoicing and accounts administration, the cost driver is customer order, the rate is $120. Marketing and order negotiation, $300 per customer visit. Customer support, including after sales, ₹50 per customer service hour. Engineering, design and support, ₹80 per engineering hour. So this is the basis of activity-based costing, that the activities are set up and identified, and then a cost driver is assigned to each activity and a rate is established. And the drivers that we saw here in this example are nearly the same as what we have seen earlier on. We have seen that direct labor and machining are the unit level activities, and we normally use direct labor hours and machine hours as their cost drivers, and so on. We use production scheduling and setup as activities, and the production runs and setup hours as their cost drivers. So for each activity, a cost driver has been set up and the rate has been established, and now we can use this rate to arrive at the cost of the product. And we have 500 units in our order, so in our case we are going to use this rate, this cost driver rate, for 500 units and arrive at the cost of the 500 unit order. Estimate of cost of resources required to fulfill the order. The unit level expenses are direct material, direct labor and machining. And for 500 units, using our cost drivers, we can see direct materials amount to 11,000, direct labor 10,000, and machining 15,000. This gives a total of 36,000 for unit level expenses. Batch level expenses, these are purchasing and receiving material, scheduling production, setting up machines, packaging and delivery. And again, the batch level, we said, is the level where the quantity is going to be irrelevant, the quantity of the order. So in case of purchasing and receiving, we are faced with a quantity of 6 purchasing and receiving orders, and the rate is 6, so the cost is 600. Scheduling production, here the cost driver was the number of production runs, and again this is not related to the quantity of the order. So the rate is 250 and there were 4 production runs. Here the cost is 1,000. Setting up machine hours, here again it was a question of setup hours. There were 3 hours per run, there are 4 runs, and the rate is 120. This gives a cost of 1440. delivery is 400, the total batch level expenses amount to 3,440. Product sustaining expenses are engineering and design, and that was 50 hours at the rate of 80, that's 4,000. Customer sustaining expenses, these are marketing and order negotiation and customer support of 50 hours. The total customer sustaining expenses are 3,100, giving the total cost order of 46,540. So here we have arrived at the total cost of the order of 500 units. We have taken the various activity levels, the unit level activity, the batch level, product sustaining, and customer sustaining. And we have used cost drivers to arrive at the cost of 500 units. We have seen that in the unit level activities, we were using the cost of 500 units, but for batch level and product level, those type of expenses were not related to the quantity of the order. And that is the advantage of using the activity-based costing, and therefore that gives us the cost of 500 units, and we arrived at the total cost of 46,000 odd. That is the total cost of 500 units for this order. We have said that the batch level, the product sustaining, and the customer sustaining, these activities, they did not relate to the quantity of the order being processed. They had different cost drivers, and that is on the basis of resources being consumed by these activities, which is independent of the number of quantity in the order. The full cost, excluding facility sustaining cost, of the order is 46,540. Facility sustaining costs are incurred to support the organization as a whole and not for individual products. The full costs that we arrived at, it does not include the cost of facility sustaining. We have said in our discussion earlier that facility sustaining costs are those costs which are incurred for the entire facility, for the entire organization, and we said that these should not be allocated to any product, as this allocation would be necessarily an arbitrary allocation. Arbitrary means a generalized, use some basis which is not directly related, what we have referred to as cause and effect relationships. Those are not directly identifiable costs, and therefore they have to be allocated on different bases, and they provide generalizations. So we have said it is better to take the facility sustaining expense and deduct the entire expense from the contribution from the order. So we have not charged any facility sustaining cost as yet to this order. The total cost arrived at was 46,540, and so therefore now, in order to have an estimate of the full cost, a markup will need to be added to account for profits as well as for sustaining the facility. To determine a proposed selling price, an appropriate percentage markup is added to the estimated cost. Markup should be sufficient to cover facility sustaining cost and a profit contribution. Assume Cholistan company adds 20%, it would give a price of 55,848. In other words, 9,308 would have been added. This is cost plus pricing. So this matter of adding a markup for facility and markup for profit is going to be something that needs to be decided by the company. They need to carry out a detailed cost analysis and consider what profit markups are suitable, and then based on that they will arrive at a percentage. In our example, we have used 20%. 20% on top of the total cost that was calculated of 46,540, and 20% was added on to that, which was an addition of 9,308, give you a total price that can be charged to the customer. This is now the price of 500 units have been costed and a price has been established for this order. Consider a purchase order of 3,000 units instead of 500 units, where the batch level expenses remain unchanged. Cost of resources used will be unit level expense 36,000 times 6, 216,000. Batch level expenses 3440. Product sustaining expenses 4,000. Customer sustaining expenses 3,100. The total cost of resources 226,540. The cost per unit for 500 unit order, where the cost was 46,540 divided by 500, came to 93.08 per unit, whereas the cost per unit for a 3,000 unit order is 226,540 divided by 3,000, which is rupees 75.51 per unit. So here lies the advantage of using this activity-based system. We have seen the cost of 500 units and we have seen the cost of 3,000 units. As we have said before, that certain costs are not going to be related to the size of the order, and those were the batch level costs, the product sustaining costs, and the customer sustaining costs. And essentially, when we are calculating the cost of a 3,000 unit order, the cost that is going to change is the unit level cost. So in our case, where we have used for 500 units the unit level cost of 36,000, here for a 3,000 unit order, that cost will go and increase by 6 times. And that cost has increased, whereas the batch level and the product and the customer level costs have remained the same. So that's why we come at a total of 226,000 odd expense for the total 3,000 unit order, giving us a reduction in the cost per unit from nearly 93 to about 75. This reduction is because all the other costs that have been stated have remained the same, even though the units in the order have increased. So this shows us how the cost per unit can change as the order size increases, and it is possible using the activity-based costing to arrive at a cost which will give you an accurate reflection and enable the firm to set a price which is most appropriate. That's all for today. Thank you very much.